You're listening to Toronto's #1 real estate podcast, powered by Watson Estates. The most successful local real estate investing starts right here, right now. Here's your host, broker, investor, and social media influencer, Bradley Watson.
Good morning, investors. Bradley here from Watson Estates. Happy Hump Day, August 12th, 2020. We are the largest and fastest growing podcast for Toronto real estate on iTunes, Spotify, and Google Podcasts as we continue to map out what in the world is going on in the GTA's housing market. And obviously there's a lot of news. There's a lot for us to cover. And I, as a broker and investor myself, want to know where there's opportunities in and around our city. And what a great day to talk about some of the things happening locally. But the big topic I want to discuss today is risk. And there is clearly different people with different risk tolerances that are fighting in the public eye. And we're going to talk about the different perspectives and how that has impacted different investments and who is winning, who is losing. You guys ready? First off, what makes a city worth investing in the GTA? So we're going to pick what region we want to invest. We're going to put our dollars, we're going to put our money where our mouth is, or where my mouth is. Hopefully you're not taking my advice that closely. But we want to know, where do I want to invest as an investor? Too many words invest in there. So we're going to talk about what makes a good investment if we're looking at cities. What should we be tracking closest? And are home builders building, or are they just running to the Muskokas these days? Like, are they just trying to get away? Are they running for the Halton Hills? Or are they actually putting money in, building? Is construction happening? Because there's been a lot of concerns that it would not. And we're going to talk about that. And then, are Toronto rental prices on par with the GTA now? Whether you're a renter or a landlord that's dealing with many renters, and I know that's got a whole bunch of challenges right now. But one of the big issues is Toronto's lack of affordability for rental spaces. Well, maybe we're nearing a time when it doesn't actually look all that different than the GTA. So a lot of great stuff we're going to cover today. Thanks again for joining us. Make sure you leave us a subscribe, leave us a like, give us a thumbs up. I'm actually up at the cottage and we're kind of taking some time out to connect with you guys because I don't want to get cold. We got to stay hot. Speaking of hot, CMHC has got a bit of a hot head as they plead with the Canadian banks to avoid risky mortgages. This is really where I want to get into this idea of risk. Because CMHC, as we've seen, is extremely risk averse. Here's a little article that came out of Bloomberg. The head of Canada's Housing Authority implored the nation's lenders to, quote, reconsider offering mortgages to highly leveraged households, saying excessive borrowing will worsen the pain of the coming economic adjustment. Evan Siddall, CEO of the Year from the CMHC, said the government-backed insurance provider has lost market share due to restrictions it imposed on high-risk borrowers earlier this summer. You guys know how they made it a little bit more difficult. And what happened? Did it make things safer? No, it just sent people to the other insurers. Private insurers have picked up that business, weakening CMHC's position and threatening the agency's ability to protect the mortgage market in the event of a crisis, he said. Can we have our business back, please? Please. I'm sorry. Maybe they've got too much heart to be successful in business. You need to take risks. Studies show people with more curves have a higher risk, for example, of catching COVID. Scientists right now, they're working on how to flatten the curve. And research shows that bad jokes as well increases the risk of getting sick because it makes you facepalm. Don't touch your faces. All right, let's get into real estate. So we can clearly see CMHC is very risk averse. You as an investor need to decide, how are you going to take risks? What kind of risks will you take? And part of that decision as well is what cities should you be investing in? Because we want to obviously mitigate our risks. We want the best opportunity, but you can't just sit on the sidelines. And this is the big difference that we've seen with many people who sat on the sidelines to the point of missing out. They've missed out. So we're going to highlight today an article came out of Toronto Stories, Oshawa. Oshawa's housing market rebounds as sales soar 66% in June. But I don't want to just talk about Oshawa. because the Dirty Schwa is a great place to invest, no questions asked, but I want to dive into what they're saying makes Oshawa great and translate that into any of our investments across the GTA or outside the GTA, depending on where you're getting cash flow. So here's what they say. Located just under an hour east of Toronto, you'll find Oshawa, the largest community in the Durham region and a major contributor to Southern Ontario's economy. However, the state of the Oshawa economy has been under pressure for the last couple years, particularly in the automobile sector. As you could imagine, these conditions have were exacerbated by the coronavirus pandemic, which brought an abrupt pause to the regional economy and jobs, right? But as the province continues to reopen, Oshawa, like many neighboring cities, see, not just Oshawa, has entered into, quote, a recovery phase. And Remax puts it, there's proof in the rebounding real estate market. So let's look at what makes Oshawa worth talking about. And I'm going to dive into what they're saying about Oshawa, and I'm going to explain that at a higher level. According to Remax, the percentage of monthly income required to buy a home in Oshawa is approximately half of what it is in Toronto, which may be enough of an incentive to move east all on its own. And this is why east has been cheaper, even for rentals. If we look down in the city, slightly cheaper. But the big thing here is, as we're looking for opportunities to invest, is affordability. There is clearly an affordability crisis in Toronto, which is pushing people above COVID itself, pushing people away. And it has been happening pre-COVID. People running to areas that are more affordable. You want to get more bang for your buck. And as investors, we do too. And this is why Oshawa is a great market, but that doesn't mean it's just Oshawa. If you're looking for a place that is undervalued or underpriced and has the affordability, you can pretty much solidify the fact that when you go to sell that thing later, there's going to be people there to buy it. Because if you're buying a too high an end home, yes, it might have high growth rates, but how easy is that thing going to be to sell? The next thing they say is, what's more, when you factor in future employment growth trends in the area, such as healthcare, artificial intelligence, and cybersecurity, did you know Oshawa was big on these things? Oshawa is on track to be an important economic engine in the province. So what are they saying there? Jobs, employment. So although Oshawa has been kind of the poster child for scary employment as we've been impacted in the automobile industry, they are actually right now being looked at as a place with opportunities, with jobs, and employment is going to drive a market. The next thing they say here, another aspect that makes Oshawa so appealing is that the housing market was experiencing a surge in the months leading up to the pandemic. Well, wait a minute, what? According to Remax, from November to the beginning of March, the average sold price for all properties, detached, townhomes, and condos spiked more than 12%. Well, wait a minute. So what is that? Why does that matter? Well, this little thing called momentum. Oshawa had momentum pre-COVID. It's a lot easier to keep a ball rolling when it's already rolling. It takes a lot more effort to get it rolling after the fact. And because Oshawa was already doing well, it was far easier to get the wheels turning again on the other end. So there you have it, guys. Affordability, jobs, and momentum. In our next article, we're going to talk a little bit more what else matters as we're looking at different regions. But they say this article continues. Of course, housing prices experienced a slight correction. We can't ignore that. And they say the latest numbers are pointing to a steep rebound in Remax. So we got to still be careful. But in June, Oshawa's housing prices advanced with an average price for home in Durham region reaching $685,500, a 10% increase year over year and up 5% month over month. So actually in the last month, this is why they're really in the light right now. In the last month, they did very well, month over month. Transactions in June were up 66% month over month, and new listings were up 63% month over month. So slightly tightening of the market, not as hot, in my opinion, as some other regions, but still a tightening, which is a common theme we're seeing out in Durham. Even now, inventory is low when compared to the number of buyers looking to purchase a home in Durham region, and they are selling very quick and with multiple offers. And there are different investors that have different takes on that. Some want multiple offers because it's like there's a lot of buyer demand. There's a lot of opportunities. Some people don't want multiple offers because they'd rather enter a market at a time when people are leaving or there's more discounts available and then sell in the environment of the multiple offers. But whatever your approach, this is what's happening right now in Durham, and make your investments accordingly. But they're saying this out of Durham. I am starting to see an increase in listing activities on a daily basis, and I do suspect that we will be seeing an increase in inventory in the upcoming weeks as people begin to reevaluate their living needs. At the same time, I do suspect demand will continue to outweigh supply as we see a transition of people moving from Toronto into Durham. So that transition from Toronto to Durham is what is keeping Durham afloat. But what about the people transitioning into Toronto? That's not happening at the same capacity. So with all these things equal, as listing activity goes up, as new listings come on the market, if we don't have the buyer demand in the next couple months, we got to be careful because we're going to have rising months of inventory, especially in different segments. And we've been tracking that as well. So for those looking for more affordable housing options, Oshawa should definitely be considered because despite the slow but steady growth in the housing prices amid lower inventories, the city continues to rank in the top 10 of Canada's most affordable cities. They actually beat Hamilton, Kitchener-Waterloo, and Victoria. Also great cities. All of these are great cities. But you can't be afraid, back to our topic of risk, you cannot be afraid of investing in the market. People are making money even now. And others have no problem. Some have no problem stepping up to steal the show. Speaking of stealing, you guys have to know when I'm transitioning into a punchline here. By now, I'm sure you guys are like, oh, here we go. Speaking of stealing, I stole a board game once. It was a risk I was willing to take. All right, let's move on to our next topic. This idea of home builders. Are builders running for the Halton Hills? Are they running for the Muskokas? Are they saying screw it? Or are they building? Are they building and hitting the highest levels since 2017, defying CMHC's forecasts? Well, an article from the Globe and Mail tells us that is the case. They are, in fact, defying gravity. Housing starts increased 16% in July compared with June, to a seasonally adjusted annual rate of 245,500, according to the CMHC. That was the highest level since November of 2017. And another month that defied the agency's forecast for a huge decline in building. You guys are wrong on that too. They're wrong on that too. And we're going to get to why CMHC is so pessimistic about the market, because they do give their reasoning. And once you've heard their logic and the reasoning behind it, you can decide if you agree as well, which is great. In Toronto, housing starts jumped 22% to 48,000 units on an annualized seasonal adjusted basis. New construction also climbed in more affordable areas outside of Toronto, such as Hamilton, St. Catharines, and Niagara areas. So we have development all across the GTA, all within the Greenbelt. In Hamilton, housing starts more than doubled from June to July after several months of weakness. The city, about a 1 hour drive to downtown Toronto in the little traffic, has become I love how they say that, in little traffic, when there's not that much traffic, has become attractive for first-time homebuyers who cannot afford Toronto, where a detached house now costs well over $1 million. So it's more affordable. Again, affordability. But what does CMHC have to say about this? There is a bit of catch-up. There's been a bit of catch-up, I guess, adding that some regions were rebounding from a steep decline shortly after the pandemic. But they're like, okay, well, I mean, if you compare it to where we were after COVID, then yes, there's increases. I mean, oh my gosh, these guys should just be like better dwelling. I bet you it's the same people. They're writing those articles. Right? Like, I get it. We need an opposition. We need a second opinion, the outside view. But does it have to come from the government? Okay, that's what really throws me off. The increased building comes as residential property resales and home prices climb due to strong demand and record low mortgage rates. So here's what they say. When the resale market is strong, that gives us the confidence to launch new projects. So remember I said we're going to come back to where is a good area to invest? Right here, guys, listen to this. This is a factor you're going to want to consider as you analyze local markets. And this is what the big investors are doing. If you're not doing it, you're missing it, okay? Year over year, or even quarter over quarter, like from Q1 to Q2 or from Q1 versus last year Q1, you want to analyze, and this is available, by the way, on CMHC's website. You can go on, funny enough, you can go on the website and they track these things. So you can track new projects, what are the new starts, as they call it, completion rates, how many projects were completed during that time, and is it growing? Like, are we increasing? Right now, a lot of them are. And then this other idea of called absorption rate, the amount of things that are being created, how many of them are actually selling and getting filled. And if the absorption rate goes down, then there's less incentive to build. So you're going to build and you're going to want to sell it. And they actually run a lot of these housing starts. They are a reflection of earlier demand because developers, they break the ground on a new condo building after the majority of the units have been sold. And it takes about 10 to 15 months to pre-sell a new building and start construction. So the growth we're seeing right now is the work that's been put in, and a lot of people won't like that I say this, by Doug Ford, and the ability to streamline the process of development. So that process that we've been experiencing over the last couple of years, you're now just seeing it. And people would say, well, this is the last time we need the development. Well, not really. We're seeing this is a blip, this COVID fluctuation. This is a blip. In the big picture, we desperately need more supply in the GTA, and this is what we're experiencing. There is a long lag. Here's CMHC. Ready? Opposite point. There is a long lag between the sale and construction. So a lot of the strength we're seeing are sales that happened prior to pandemic. Oh, okay. Yeah, except you're forgetting to mention that builders haven't reduced their prices at all during the pandemic. They're just not. Regardless of the lag, Mr. Dugan from CMHC said he was surprised by the strength of the property markets in June and July. However, he said 2 months of strong activity was not going to alter CMHC's forecast for a downturn in building and home prices, given the state of the economy and unpredictability of the pandemic. And then you wonder why you're losing market share. Guys, no risks. No risks. They're taking zero risks. And I mean, I don't want the government taking risks either. I want them to be conservative, but let's be realistic here. And let's instead of saying these are why we think that, let's put that at the forefront. Why don't we just tell people and let them make the decision? These are the looming risks. That should be the first thing, not we're going to be screwed and here's why we think we're going to be screwed. It should be, this is why we're concerned, and you guys make the decision and play it safe. And I think that's what you got to do to inform people. CMHC's outlook, which was released in May, predicts housing starts could decline as much as 75% from peak to trough. 75% drop? Where is that happening? And home prices could fall between 9% and 18%, which we've been talking about. That has not happened yet. Can it happen? Maybe on the short end of that prediction, maybe. But I think more likely, even in the condo space, which has been trampled in the last couple months, I'm starting to see that it's getting a little bit of a footing underneath it. And I think mostly the fluctuations you're going to see and experience are going to be seasonal in nature, not so much for selling. Hopefully that makes sense. But what are the risks that they're looking at? Here they are, guys. This, again, should have come first, but it's not. And so if you want to know, why does CMHC think we're screwed? Here's why. Here are the risks they're looking at. 1, high unemployment, which is improving, by the way, but it's still high. 2, no immigration, which is improving, but it's still low, right? Homeowners unable to resume mortgage payments after their 6-month deferral end. You know my thoughts on that. The numbers are out. That really doesn't seem to be having that much of an impact, but okay. And also the transition from Ottawa's pandemic financial aid to employment insurance, from that transition from CERB to EI. What is that going to look like? Yes, that's reasonable questions, but these are the things they're looking for. And the second outbreak is that is that monster in the closet. It's like, son or dad, can I come? I'm making this up on the spot, so I'm going to butcher this one. Dad, can I sleep with you? And the dad's like, no, son, I can't risk the monster coming in with you. But CMHC, they're all like, no, we ain't eating the alphabet soup. We refuse, because we refuse to risk taking an L. And that is the case. For you old people, taking an L is a loss, by the way. All right, so before we get into our last topic, this idea of renters and rental rates, some highlights, some big points that I could make a whole podcast on just these, but we're gonna graze through them, okay? Number 1, in fact, the top article on the news today is clickbait. It's totally clickbait, because what it's called is RioCan sells 50% interest in Toronto, Ottawa developments. It's like, what? RioCan sold half their developments? No, not. This is why this is a subtext in my podcast, because it's totally it caught me too, guys. I get caught too, but I read it. That's the difference. We actually read it. So RioCan, as you know, is huge. They have 221 properties. They have 38.6 million square feet. They own residential rentals and 15 development properties and offices, a lot of stuff. So it's like they're going to sell half? What? No, that's not what's happening here. It says this: RioCan REIT has continued its trend of bringing in partners on major developments, selling 50% interest in 2 of his residential-based projects, Maple Ends Development in Dufferin Plaza in Toronto and Killam Apartment REIT Luma at Elmvale in Ottawa. So when they say they're selling 50% interest in Toronto, Ottawa, it's literally in just 2 projects. And so what RioCan is doing is they're reducing their risks, and they're reducing it in trading animal futures. You can call them a hedgehog. They're a hedgehog. Okay, we're going to move on to the next thing. The next topic here, highlight, is the highway. The major 400 series highway. I have not talked about this, and I apologize because you know what? I didn't think it was going to be big news because it was more of just like a hey, FYI. But I have known about this since the moment it happened because I've got properties that are impacted and in the good way, being near this route. So here's the news. Ontario plots their preferred route for the major new highway through the Toronto area. If you're wondering, am I affected? Well, what it's going to do is revive last year. This was an idea that had happened. It got squashed because it obviously affects the Greenbelt. And people don't like that, but it's been revived again. Thank you, or get mad at Doug Ford, however you want to look at that. And it's going to run southwest from Highway 400 in Vaughan through Bolton, Caledon, and Brampton before turning south and terminating at the junction of Highway 401 and 407 at the westernmost tip of Mississauga. So it's going to loop around. It's going to take a lot of the pressure off the 401 and off the 407. Are they going to sell it like the 407? I bloody well hope not. But we're going to have a little bit more support moving east and west and then back down south. And the preferred route was released on August 7th, the preferred route. But there's going to be another environmental assessment that's not going to be announced until 2022. But if you want to see where is the route, this is based on their kind of consultations. You can go online and check that out. It's kind of cool. Kind of cool to think about it. It's going to take us until probably 2030 or mid 2020s at least. Actually, 2030 I think was the number that they said before it actually rolls out. But this is great news for those near the highway, unless of course your land is getting expropriated. But please be careful if you guys run out to purchase a vehicle to use on the new highway, because you'll be at risk for the car owner virus. So stupid. I kill myself. You know what? I get flack for this all the time. I laugh at my own jokes, and it's so true. Is that a bad thing? I don't know, but I do it. City News 11:30. They published an article. Our last one before we get into the hot topic of renters is Bank of Canada. This is what it's called. Again, clickbait. The clickbait is real out here, man. Bank of Canada expected to cut mortgage rates to near record low. That's the heading. But really, what the article is talking about is the Canadian Mortgage Brokers Association expects this week. The Bank of Canada, and probably today, a lot of Bank of Canada announcements are on Wednesdays, they're expecting to reduce the benchmark 5-year rate. Not the rates. We've seen CIBC and BMO have cut their 5-year mortgage rates by 15 basis points earlier in the week, which is like kind of a leading indicator. But they're expecting they're going to bring it down from 4.94 to 4.79. You're like, I don't want a 4% mortgage. No, that's not what that is. That's the benchmark qualifying rate. So it just means people will qualify for mortgages easier next week than they did this week. And it's not the lowest it's ever been. When it was initially created, the CMHC limit they put on a couple years back, it started at 4.64. So it's not the lowest, but it's the lowest we've seen since then. So things are going to get easier to qualify for a mortgage. That's the lesson to take out of that one. Okay, guys, I'm excited about this last topic. If you're still here, thank you. This idea of rents, right? Rentals. A lot of the reason a lot of people don't want to buy investment properties to rent in Toronto, or they don't want to rent in Toronto as a tenant, is that it costs too much, right? This idea of why would I pay an extra $400 to rent in Toronto when I can rent along the GO line and just, commute in when I need to, and I don't even need to do that anymore. So as we start to see an equalization of rental rates, so like if I were to ask you guys, if Brampton and Toronto were the same rent, if it was the same cost to rent in Brampton or Toronto, all things equal, forget where you live or forget where you work, where would you want to live? I believe the answer is Toronto. I believe that, unless you had other outside factors to drive you in. So as the rents become closer together, naturally you're going to start to see, if anything, not declining rent rates in Toronto. Hopefully that makes sense. Well, now we're getting an article. This came from Mississauga.com. Average one-bedroom condo rent in Brampton, Mississauga nearing Toronto prices. According to the most recent quarterly GTA market condo rental report from TREB, only $80 separates average monthly rent for a one-bedroom unit in Brampton and Mississauga compared to the neighboring Toronto. Again, $80 difference. I'd live in Toronto for an extra $80. Between April and June of this year, a one-bedroom apartment-style condo rented for $20.30 per month in Brampton, Mississauga, compared to the average $21.10 in Canada's biggest city, just 3.8% cheaper. Not a big difference. Rental rates have climbed steadily in all three cities, and in the second quarter of 2015, one-bedroom condos in Brampton and Mississauga were 10.3% cheaper. So that gap has closed significantly, of course, because rent rates are dropping like flies here in Toronto. Treb said it's seeing a leveling out for condo rental prices over the past 18 months due to the increase in supply, with Toronto even seeing a 5% decline compared to the same quarter in 2019. It's not that Brampton and Mississauga getting more expensive, which they are slightly. The bigger story is that Toronto rent rates have dropped so significantly that they've put them back on par with these outskirt communities. So now if affordability continues to be a big argument for not living in the city, then now we have balance in our market. So does that mean, as I've said, and I still stand by, I believe we are either at or near or coming up from the bottom of rental rates in Toronto. We're in that zone, guys. We're in that zone, and this is one more article to put in your back pocket. So if we want to invest in properties and you're thinking, you know what, I'm concerned by the risk of rent rates going down and down and down, well, you need to take risks if you want to win in real estate. This is the case. This has been the case for people who invested back in March and April when you didn't, and are now hundreds of thousands of dollars ahead. You know who doesn't take risks? Vegans, because their life could be at stake. All right, I'm going to leave it there, guys. We're going to have some fun today at the beach. I hope you guys have a wonderful day, and I don't know if I'll be on tomorrow. We'll see. If there's enough news for it, we'll do it. If not, I'll see you guys in the next couple days. I'll see you next time. Take care and keep it real.